January 28th, 2021, 9 a.m. Eastern. A trader named Keith Gill refreshes his Robinhood account. Yesterday, his $53,000 position in GameStop was worth $48 million. Then he sees it, a gray button where buy used to be. Across the country, millions of retail traders open their apps to the same message. Trading restricted. Not for institutions, not for hedge funds, just for them. Within hours, GameStop will crash from $483 to $112. By day's end, $6.8 billion in hedge fund losses will be erased, not by the market, but by a broker that turned off buying for retail investors only. This isn't a story about a meme stock. It's a story about what happens when the casino realizes the house is losing. Go back 18 months. September 2019. A user named DeepFuckingValue posts an WallStreetBets, a Reddit forum known for risky trades and crude humor. He announces he's putting $53,000 into GameStop shares and call options. The video game retailer everyone thought was dying. His peers call him an idiot. But Keith Gill, later revealed by Reuters to be a financial analyst from Massachusetts, keeps posting. Month after month, he explains why GameStop is undervalued. More importantly, he points out something strange in the data: the short interest. Hedge funds weren't just betting against GameStop. They were shorting more shares than existed in the tradable float. At one point, the self-reported short interest hit 140% of shares outstanding. When you account for only the publicly tradable float, some estimates put it above 226%. Think about what that means. For every 100 shares that regular people could actually buy and sell, hedge funds had borrowed and sold 226 of them. It was mathematically impossible unless shares were being borrowed multiple times over. One fund led the charge, Melvin Capital. Founded by Gabe Plotkin, a former SAC Capital portfolio manager, Melvin had built its reputation on identifying failing retailers. GameStop, with its mall locations and physical game discs in a digital world, looked like easy money. By January 2021, the consensus was unanimous. GameStop was a dying brick-and-mortar relic. Melvin Capital and dozens of other funds held massive short positions. They'd borrowed shares at $20, planning to buy them back at $5. The put options market implied a 95% probability the stock would decline. Every institutional analyst had a sell rating. And then DeepFuckingValue's post started getting traction. January 11th, 2021. GameStop closes at $19.94. By January 13th, it's at $31. Not a crash, not a rumor. Just thousands of retail traders on WallStreetBets realizing what Keith Gill had been saying for 16 months. If everyone bought and held, the short sellers would have to cover. And with 140% short interest, there literally weren't enough shares to cover. The mechanics are simple. When you short a stock, you borrow it and sell it, hoping to buy it back cheaper. But if the price goes up instead, you have losses, and eventually, you have to buy back the shares to close your position. That buying creates more upward pressure, which forces more short sellers to cover, which creates more buying. It's called a short squeeze. And with GameStop, the math was absurd. Melvin Capital and other funds had collectively shorted more shares than could physically be bought. Here's what everyone missed. The signal was public. The short interest data was published every 2 weeks by FINRA. Anyone with a brokerage account could see it. Keith Gill wasn't using insider information or complex algorithms. He was reading the same reports available to every retail trader in America. But here's where it gets strange. The WallStreetBets community didn't just see the numbers, they weaponized them. Posts started appearing with titles like GME Short Squeeze Case Study. Users calculated exactly how much the short sellers would lose at different price points. They coordinated buying, they held through volatility, and they gave it a name: Diamond Hands. By January 25th, GameStop hit $76. Melvin Capital's position was underwater by hundreds of millions. On January 26th, the stock closed at $147. Melvin's losses had ballooned to over 30% of the fund's entire value since the start of the year. And this is the part nobody talks about. On January 27th, two firms, Citadel LLC and Point72 Asset Management, injected $2.75 billion into Melvin Capital. $2 billion from Citadel, $750 million from .72. It was a bailout. A hedge fund that had made a catastrophically wrong bet was being rescued by two of the largest players on Wall Street. Citadel, remember that name. January 28th, GameStop opens at $265. By 9:30 a.m., it's approaching $500. Keith Gill's $53,000 investment is worth $48 million. Thousands of retail traders on WallStreetBets are watching their accounts multiply. The short squeeze is working exactly as predicted. Then, at 9 a.m. Eastern, Robinhood, the app used by millions of retail traders, restricts trading. Not just GameStop. 13 stocks that had been popularized on WallStreetBets. The buy button turns gray. Selling is still allowed. Buying is not. The stated reason, risk management decision. But here's what the numbers show. On January 25th, Robinhood's daily deposit requirement with its clearinghouse was $125 million. By January 28th, that requirement had spiked to $1.4 billion, an increase of over 1,000% in 3 trading days. The National Securities Clearing Corporation, which processes trades, had demanded Robinhood post more collateral because of the volatility in meme stocks. But there's one number, and it told a completely different story. Robinhood's initial blog post on January 28th mentioned only market volatility. The clearinghouse requirement, not mentioned. When questioned later by Congress, Robinhood admitted the restrictions were to meet financial requirements. But the public explanation had omitted that entirely. With retail buyers locked out and sellers still active, GameStop crashed from $483 to $112 in a single session. Hedge funds who had been losing billions now had an exit. The short interest started dropping. Melvin Capital, which had lost 53% of its value by the end of January, stabilized. This is where it stops being a coincidence. Citadel, the same firm that had bailed out Melvin Capital with $2 billion, was also Robinhood's largest source of revenue. Robinhood makes money through payment for order flow, sending its customer trades to market makers. Citadel Securities, the market-making arm of Citadel LLC, paid Robinhood hundreds of millions annually for that flow. When Robinhood restricted buying, it directly benefited the firm that had just rescued Melvin from collapse. The short squeeze had worked. Then the platform turned off the buy button, only for retail traders. The trap has a name, access asymmetry. When a crisis hits, institutions get options retail traders don't. Here's how it works. Retail traders use apps like Robinhood because they're free and simple. But free means you're not the customer, you're the product. Robinhood's revenue comes from selling your order flow to market makers like Citadel Securities. When volatility spikes, Robinhood faces massive collateral requirements from clearinghouses. And when that happens, Robinhood has two choices: raise billions in capital overnight or restrict trading. Institutional investors don't use Robinhood. They have direct market access. They have credit lines with their brokers. When Robinhood turned off the buy button, Goldman Sachs traders could still buy. Citadel could still buy. Melvin Capital could still close positions. Only retail traders were locked out. You've seen this pattern before. In 2008, when Lehman Brothers collapsed, retail investors couldn't pull money from money market funds, but institutional clients got early redemptions. In March 2020, when COVID crashed markets, circuit breakers halted trading for everyone, but high-frequency traders had algorithms that reactivated in milliseconds. The mechanism is simple. In moments of crisis, access to markets becomes tiered. Institutions are Tier 1, retail is Tier 3, and when the system is under stress, Tier 3 gets restricted first. The lesson isn't that markets are rigged, it's that the infrastructure of markets, clearinghouses, brokers, payment for order flow, creates structural advantages that only become visible when something breaks. 3 years later, the pattern is appearing again. In March 2023, when Silicon Valley Bank collapsed, retail depositors panicked, while venture capital firms quietly moved billions through private banking channels. In the 2023 Treasury market volatility, high-frequency trading firms maintained access while retail bond platforms froze pricing updates. What makes this analytically interesting? The infrastructure hasn't changed. Retail traders still use payment for order flow brokers. Clearinghouses still demand collateral spikes during volatility. The same structural asymmetry that locked out WallStreetBets in January 2021 is still embedded in the system. The question isn't whether another meme stock will emerge. It's what happens the next time retail traders are on the winning side of an impossible trade, and whether the buy button will work. Watch for volatility that threatens institutional positions. That's when access asymmetry becomes visible. Keith Gill testified before Congress in February 2021. When asked about his GameStop investment, he said, "As for me, I like the stock." By mid-2024, his disclosed position was worth over $116 million. Melvin Capital shut down in 2022, having never recovered from its losses. Robinhood paid $70 million to settle claims over the trading restrictions, but admitted no wrongdoing. The market isn't rigged, but it has gears. And in January 2021, millions of retail traders learned the hard way. You're allowed to play the game, right up until the moment you start winning. Then the casino closes your table. If this is the kind of story you want to see more of, you know what to do.